Good afternoon, everyone. This is Andrew McGill speaking. Thank you for taking your lunch hour with us today for our October monthly webinar. This webinar is entitled Life, Death, and Disability. Only one is under your control. And I wanted to share what our intention was for our webinar today. In the spirit of Halloween, life insurance, disability insurance, I find people often have they're scared of it, they don't know what it is, and it can sometimes be even scarier than a haunted house. So what we want to do today is to educate you and dispel you of some of this fear. And to do that, we've invited Brad Kudelski, who is an expert in this space, and we are so excited to have him on board. So with that, Brad, would you mind introducing yourself?
Sure. So my name is Brad Kudelski, and I own a firm and work with 12 Points, and we specialize in all different things from life insurance to disability insurance to long-term care insurance. I've been in the business now over 20 years and help with different things from both strategy and planning to things like impaired risk or health, what we'll refer to as health insurance challenges. For people that might not be in the most perfect health, we can help guide the maze of all the different carriers and try to figure out which one might be the right fit for someone.
Perfect. And yeah, thanks, Brad. And
Thank you.
As I mentioned at the front, my name is Andrew McGill. I'm a wealth advisor here at 12 Points. So on a daily basis or regular basis, I'm working with Brad. Our team is working with Brad to help our clients acquire insurance. And the nice thing about working with Brad is not only his expertise, but it is also his ability to have access to numerous insurance carriers. Because anytime you're looking at any of this, as we'll get into, making sure you're not just looking at one company, you're looking at a host of companies that is best suited for you when you're getting insurance. So thank you again, Brad, for joining today. And I'm going to switch over. We'll dive in here. So,
yep.
And what we'll first start with is life insurance. And what is life insurance? So at its core, life insurance is a legally binding contract with an insurance company where you pay a lump sum of money or a regular payment, maybe it's monthly, maybe it's annually, and in return, if something were to happen and you were to pass away, the insurance company will pay you or your beneficiary a lump sum. And there are many different types of life insurance and many reasons why people buy life insurance. So I thought we would dive into what are the different types. So Brad, would you mind sharing those?
Sure. So yeah, life insurance is kind of like ice cream, comes in a bunch of different flavors. So we have everything from what most people might be aware of being term insurance, which is strictly like your auto or your homeowner's insurance. You're paying a small premium for a set period of years for that specified sum of money at the end. Now it might come in a 1-year term period. You can get a 5-year term period, 10, all the way up to age 65. So you could actually structure a term policy that brings you right to age 65. Now that doesn't mean you can't get term insurance after 65, but you might only be able to get a smaller duration of term. So maybe a 10, if you're 60 years old today, you might be able to only buy a 10 or a 15-year term policy. They're not going to give you term really all the way to age 100, although we can do that and mimic that with certain types of policies, and we might talk about that a little bit later. Outside of that term insurance, that pure protection, there's permanent insurance. So this is the type of insurance that's really meant to last your entire lifetime. So under that permanent umbrella, we have 3 different flavors. We have whole life insurance, universal life insurance, and variable universal life insurance. Whole life insurance, the easiest way for me to explain that would be an insurance carrier is going to look at you, and let's say you're 35 years old. They're going to say, all right, from now to age 100, here's what we think that cost of insurance charge should be. And it's a level, if you were to unwrap a whole life policy, it's going to have a level cost to it from now all the way to age 100. Then in addition to that, you're going to pay a little bit more. And in return for paying a little bit more into that, they're going to put it into an investment account, being the carrier's whole life bond portfolio. In addition to that, you also get what you'll hear are dividends. And all a dividend is the company's profitability getting returned back to the consumer. And the way that works is for everyone that lives past that period when they think you're going to pass away, that life expectancy, that's a negative hit to the insurance company. But for all those people that don't quite live to life expectancy that have paid into these permanent insurance policies, there's a profit. So those profits get shared with those other whole life policy holders. Universal life is a little bit different, and variable kind of works the same as universal, where it's both a component of kind of like a term insurance, like a 1-year term insurance, along with a cash value. So if you were to draw it out on a chart, it's kind of like a parabolic going up, where in the early years, there's very low cost of insurance charges, but in the later years, there's very high. And the way it kind of levels out is the carrier just tries to figure out how much in addition to that term premium do you have to pay to make it a level premium. And under those given assumptions, in a perfect world, this policy should last all the way to age 100, or what we see now is policies going out to 121. The real difference between that universal life and the variable universal life is what you get, where you get to invest that extra money going into the policy. So in the universal life, it's going to be the company's general fund portfolio. But what we see in these variable or index policies is more into strategic either indices that you're sharing in participation with, or more of a mutual fund looking type of investment that you get to invest this extra money into. Again, the whole idea is to get the policy to last to age 100 or 120. So those are really kind of your different flavors of life insurance.
Awesome. And if anyone has any questions, you can always throw that in the chat, and we'll take a look at that and save it for the end. And Brad, thank you for explaining all of that. So let's talk about why people typically buy life insurance, and we'll move this slide here. So there are a few common reasons people buy life insurance, including income replacement, debt repayment, fund-specific events, addressing tax concerns, and covering burial expenses. But Brad, would you mind elaborating on this a little bit?
Yeah, sure. So, I mean, income replacement, again, we'll take the example of like a 35-year-old making $100,000 a year. How many years until he gets to age 65? So we got 30 years there. So a person making $100,000 all the way to age 65, if they were to just make that same $100,000, they're going to be bringing in to their family household roughly $3 million. So it's kind of the question of how much do you want to make sure of that income that's coming into your household continues to come in the household whether you're there or not. We also look at things like debt repayment, mortgages, funding specific events, college savings. You know, if something were to happen and you were to pass away prematurely, would you want to set a chunk of change set aside to help your children go to college? And then burial expenses. We all know we all have an expiration date. Do we want to make sure that there's money there to cover those costs, you know, at your demise?
And thank you, Brad.
Yeah.
I just got a note here that from Robin, thank you. Audio is going in and out. Can someone else make a note in their chat if that's still the case? Are you hearing me fine, Brad?
Yeah, I hear you fine.
Okay. Well, we'll keep going, and if I hear someone else put a note in there in the questions, we'll stop there. All right. So we'll keep moving forward and talk about the tax advantage nature of life insurance. So when it comes to tax advantage, it offers it's a significant benefit. Okay, unlike many sums of money that you may be gifted, the death benefit is received income and capital gains tax free. Not many people know that. Additionally, the cash value, the piece that Brad was just talking about before with some of those permanent policies, the cash value within those policies grows tax deferred, similar to like a 401k, providing a valuable tool for retirement planning. And then the withdrawals from cash value are taken tax-free up to what you put into the policy. And then from there, the loans can be taken out tax-free as well. We're not going to dive into the nitty-gritty of these policies, but life insurance can have great tax advantages, and in some cases, it can go well in someone's plan. So next thing we're just going to shift to is the costs, because all of these things have a cost. And what we'll dive into now are the factors that impact that. And I'm just going to change slides here. And Brad, many people are surprised to learn when you look at apples to apples comparison, when you're insuring a 55-year-old male or female, then it ends up being the male that costs more to insure.
Correct. Yeah, males tend not to live, don't have the same life expectancy as a female, so therefore we get higher prices for males and lower prices for females. When we get into the disability side of this conversation, you'll see it's quite the inverse. But I mean, Andrew and I and some of the other folks at 12 Points, we've run into a very different situations of health conditions that have come up. And this is really what differentiates us, you know, and the value of working with us is we're never bound to one specific carrier. If we get an application in with one carrier and something gets discovered, we can always pivot to another carrier. But just to kind of give you some idea of some of the things that we've come across, being in Massachusetts, one of the most common things that we keep now seeing is the topic of marijuana. Marijuana is no longer really taboo here in Massachusetts, so a lot of people talk about their usage of marijuana. And now that more people are talking about how much they use it, we run into different issues with carriers, how that affects the pricing. If you're using it daily, they're going to assess a certain pricing to you. If you're using it a few times a week, they're going to assign a certain risk to you. If you're using it once a week, they're going to assign a certain risk. So that's really where we can help out, is when you're truthful with us, we can figure out where we need to place that business and what carrier has an appetite for it. Some of the other stuff we see out there is cancers. More and more people are having different cancer diagnoses. They have family history of cancers. And again, we have to kind of weave which carriers might fit those certain risks. Sleep apnea is another common one. Tobacco use. When I first got into the business, that was a little bit more common. But what we're more seeing now in the tobacco, or what's making conversation in the tobacco side of the business, is these various non-smoking items like the vaping, the chewing. Certain carriers have certain appetites for those types of tobacco usage. And then last, I'd say that we see most common are diabetes. There's really been an uptick in type 2 diabetes. Everyone's treated differently for those type 2 diabetes, and every carrier has a different risk of appetite for different stages of diabetes.
Thanks, Brad. And I'll just share, like, one of the things that Brad and I have experienced before, and Brad many more times than I have, is we had one client who didn't tell us about, it was the chewing tobacco, didn't say that they had used it. We went all the way through the process, and unfortunately they were declined by an insurance carrier. We then took all their information and brought it to another carrier that they had been using chewing tobacco, and they were approved at a very strong rate. So it's amazing how these different carriers treat different risks, and that's why it's so important, as I said at the beginning of the call, is to look at all these different carriers when you are going through this process. And now what we'll shift to is the needs and the life stages. Okay, so at different times in people's life, they need insurance for different things. So when you have a family, a young family, often just starting out, they're thinking about life insurance when they get married or they have children, and they're making sure that their family's protected in the event that they were to pass away. As a family matures and they get older, they're thinking about securing their wealth transfers and using life insurance to guarantee that legacy. And then also not only guarantee a legacy, but also thinking about protecting from having to pay those estate taxes, making sure that you have the funds available to do that. There's different stages, and making sure that you're considering this at whatever stage you're at is very important. And from here, we'll start talking about not only at every stage you should be considering these things, but also at every stage you should be, if you have insurance, it's not just a one and done, making sure that you are reviewing the policies that you have, making sure that it still fits you, making sure you have the best policy out there. And Brad, would you mind talking a little bit about how you recommend people go about reviewing their policies and what that process looks like?
Sure. And before I do that, I'm actually going to back up real quick to that last slide because it was just something I just thought off the top of my head. Another area of concern or a topic we end up discussing is what we refer to as blended families. So those are families that have been divorce situations, and now they're both bringing children into the situation. Where we all most often find an insurance need there is, let's say I was to be divorced, I now have a new family, or a new wife, and where do my assets go at my passing? Do they just go down to my children and skip my new wife? Most often what you'll see instead is maybe a life insurance policy will be used to pass wealth to that spouse, and then the remainder assets, all those other assets you have, the house, the real estate, the cars, that'll then continue down to the children. So that's kind of a fifth area I would say in here is that second marriage situation. But with that, we can go over to policy reviews.
Yeah, I was not even thinking about that. Thank you for sharing that. So yeah, policy reviews. Would you mind sharing what that process would look like, Brad?
Yeah, so policy reviews are important, especially if you've had health challenges, that you've overcome, or for instance, you've quit smoking cigarette, but more often what we see is health challenges. So maybe someone had some sort of cancer history when they had taken out the policy and they're paying a little bit higher charge. Or what I've also seen is they had uncontrolled sleep apnea or uncontrolled blood pressure, cholesterol issues that were just not controlled from medication. They didn't get the best rates, but now we're 5-10 years into it and they've really changed their lifestyle and things are better. Well, it might make sense to review even those term policies if your health has changed. But it really is very important too with permanent insurance, just making sure the policy is performing the way it was originally illustrated. So those types of policies should really be reviewed, I'd say no more than every 5 years. But even just life insurance in general should be being reviewed because things changed. Maybe you took out that policy when you're in your 20s and you're making $50,000 a year. Well, guess what? Now you're 15 years later and you're making $250,000. And that $500,000 policy you originally took out probably isn't adequate. Maybe you're probably looking more at like 2.5 million. So really it's just changes in circumstances. Life always changes. Maybe when you first took out that kid policy, you only had one child. You didn't really think of having a second child, and now you have 4 children. So things change and needs change. So it's something that needs to be reviewed. And just as I said before, the second marriages, no one plans for divorce, but unfortunately it can happen and things change. And that's also another time to review those policies.
And thanks for sharing that, Brad. And one thing, putting myself in the shoes of some people out there, they may have term insurance policies that they put in place. And right now, maybe they're like, hey, how can I save some money? And as we both know, that insurance isn't all about saving money, but can you talk about, are you able to convert a term insurance policy over to another carrier's insurance policy to potentially save premium?
You wouldn't be converting it, but you could change over to another carrier to save premium, absolutely. Or you could keep with the same carrier, and we've looked at that in some cases, and it's what we call filing for a re-rate. So it's just getting the current policy you have and getting it adjusted for the improved health.
Perfect. And yeah, we do this a lot with folks. With maybe you got insurance during COVID, and maybe you were not at your best weight, or maybe the opposite, and you want to do what's called a re-rate. You can go through the process and see if they'll put you at a higher rate class if perhaps your health has gotten any better. So just things to consider when it comes to reviewing your policies. So on that same token, talking about failing policies, we see this all the time where people may have gotten, or parents or siblings or someone they may know have gotten a policy a long time ago, and this policy is failing on them. Maybe they haven't made the premium payments, maybe there's a loan on the policy. Brad, could you talk about some of the things that people can do to save these sort of situations?
Yeah, so again, things change. With some of those policies that we talked about, permanent policies that are more interest rate sensitive, things have changed. And what we've seen a lot of is over time, interest rates have gone down, and those have negatively affected those policies. They're now going up, so maybe we won't see it as much going forward, but there's ways to restructure the policy. So you're not finding out 20, 30 years into the policy, hey, you need to come up with a lump sum of money to save this thing. If we were reviewing it every 5 years, there might be things that we can do by adding extra money to that policy to make sure you don't get that surprise later down the road. It can also happen on the inverse, especially with these more market link type products. If you've had good returns in the market, you might not have to pay as much into it. So really restructuring and adjusting the premium payment method. And I mean, when we talk failing policies, we're talking about permanent policies. We talked about adding money or replacing it. Needs change. We've run into people with both universal life, whole life policies that they took out when they're younger, and they were going to use it as maybe a source of retirement income, but things have changed. Their other investments have done far more superior than they thought they were going to do, and now needs have changed. So we're not going to go too much into it, but the conversation of long-term care. So now we don't need those policy cash values for retirement income. Maybe we can convert that policy on a tax-free basis into a new policy that now covers long-term care. So now we have that pool of money should we need some sort of custodial care in retirement. And then the last, this is probably the last resort that we see is surrendering or selling the policy. So you have that permanent policy and you paid into it all these years. It hasn't performed well. You never had the policy reviews done on it, or things changed. You took out that policy with the business and now you're not in the business, and you don't need it. Well, there is secondary market value on these policies. There's always investors that will buy these policies. And the way they look at things is they say, all right, based on your life expectancy and what's in this policy, this is the anticipated rate of return at your life expectancy. And they try to figure out how much they need to buy that policy from you to get a certain achieved market rate of return on that policy. So it's a little bit morbid. It's really kind of the last resort, but it is a tangible asset. It is something you can sell for the death benefit.
Thank you for sharing that, Brad.
Yeah.
Now, that kind of finishes our conversation around life insurance. So now we're going to switch gears and start talking about disability insurance. And what you can see here on the slide is, what is your greatest asset? And what we would argue is it's your ability to work and to earn income. All of that money that is going to come to you, the potential that that money has over time. And if that faucet, something to think about, if that faucet were to turn off, that money stops coming in, how protected are you, and how would your plan hold up if your income all of a sudden stopped? And when we talk, a lot of times when we hear disability insurance, we just think of disability, and we just think of having a disability, we sometimes will call this should be called income protection or income insurance. It's a stoppage of income, and that's what disability insurance does. It protects that income that would come into your family if you're unable to do the duties of your job. And before you can answer this question, just like I said, if you became sick or hurt, could you survive without your income? Does your family have the means to cover the debts that you have or your living expenses? And when you think about disability insurance, a lot of times we hear over and over is people will say, oh, I have it through my work. And that may be the case, but you want to make sure you understand exactly what you have for coverage at work, because sometimes you might have a minimum coverage of maybe it's $5,000 a month or it's $10,000 a month, when you thought that your income was actually protected 60% in the event that you couldn't do your job. So looking at those fine details, working with someone to do that is critically important. And do you have anything else to add here, Brad?
Yeah, I mean, disability insurance is probably the more important, I'd say, than life insurance, only because, you know, as realistic as it is to say, if something happens to you, you're out of the picture. Granted, the income's gone, but in a disabling condition, there can be long-term losses of income, and you're still in the picture, and your expenses are much higher. And there's a variety of things that we're seeing these days. You know, it's not just people going into being confined to a wheelchair, or, you know, being a paraplegic, some sort of catastrophic. There's many different things. You know, we have so many stories of cancer, stroke, heart attacks that can really lead to that loss of income, even if it's only temporary.
Yeah, it's a great point. And what we're going to go into now is really talking more about disability insurance and some of the causes of disability insurance. So, Brad, would you mind talking us through what some of the causes of disability insurance are? Again, sometimes there's a lot of misnomers out there about what exactly disability insurance covers.
Yeah, I mean, again, we talked briefly there about the catastrophic type of things. You know, there's accidents. The reality is the majority of disabling conditions and stuff like that are not accident related. They're more illness related that we talked about, like cancer, stroke, heart disease. So, you know, what I sometimes tell people, if you picked up a medical dictionary, they're very thick. So there's a lot of things that unfortunately can happen to you. There's a lot of rare diseases. And we'll go more into the statistics a little bit later, but you know, the causes are numerous.
100%. So in terms of duration of disability, would you mind speaking to us about what those averages are and some of those statistics?
Yeah, so average duration, you know, they say is roughly 30 months. Some of the duration that we talked about here, nearly 1 in 5 will become disabled for 1 year or more before the age of 65. 3 out of 10 workers between 25 and 65 will experience an accident or illness, keeping them out of work for 3 months or longer. And I think that's probably a good segue to go right into the statistics of it.
Yeah.
And what I like to talk about that's not on this is just about the statistics when it comes to income insurance. So we talked a little bit before about term insurance and the need for that income replacement during your working years. The reality is with life insurance, the probability of passing away before 65 from either an accident or illness is only about 2%. So of all those term insurance policies that people are purchasing in their 20s or 30s, the risk is only 2% of passing away prematurely. Whereas with having a long-term disabling condition, one of the statistics I like to talk about is 1 in 7. So 1 in 7 will have a long-term loss of illness. So we talk about the risk being 1 in 3. And the reason why 1 in 3 seems so high is that 1 in 3 is just having that disabling condition. So cancer, stroke, heart attack. 1 in 3, you look around, if there's 3 of you together, there's a good chance in your working years, one of you is going to have one of those illnesses. But I think what's more critical is the 1 in 7, which is that long-term loss of income over 30 months that we have here on the screen. So an example of that, and that I like to talk about, is suppose you're a chief marketing officer in a company and you're making good money, you're making 300,000 a year, and something happens, you have a cancer, heart attack, stroke, you're out of work for a period of time. Now, fortunately, with a lot of these things, they are seemingly recoverable. So people can go back to work. The problem might be, and this is where the importance of disability comes in, is they start working back in the job, but they're no longer the chief marketing officer. They've now taken a director role. So now their income might not be 300, it might be 150. And where these disability policies come into place with the partial riders is they allow you to tap into that policy all the way to retirement for any loss of income. So in that scenario, you went from 300 to 150. Well, these disability insurance carriers will allow you to receive half of the benefit that you purchased until you get back earning where you were before. And sometimes you might never get back to that 300, going from 300 to 150 and back to 300. That might never happen. So that's really crucial to have, having these well-drafted disability policies to make up for that loss of income.
Great. And next slide, what we'll start talking about is, if this is something that people want to access, how do they do that?
Yep. So it's going to be a claim. So if something happens, we file a claim with the carrier. And what do we like to talk about with how to file these claims is, again, it's not catastrophic. Sometimes in an employer-based coverage, we'll see more catastrophic type of language, but in an individual policy, they're a little bit more liberal. It's not the carrier just coming out and sending their doctor to take a review of you. You have your own doctor basically filing that claim paperwork and stating whether they feel you can go back to work. If there were that gray area, it would go into mediation. But with most individual disability policies, we find the language very broad, very liberal. They're a little bit easier to make claim on. If you went down the spectrum of this, you'd have group disability. Group disabilities has a little bit more wiggle room for carriers to wiggle out of the claim. And I think we might go into this a little bit later, but Social Security is probably the most difficult form of some sort of long-term disability that you're able to make claim on. What we will warn people is when you're trying to make a claim on Social Security disability, you're most likely going to get declined the first time around. We often see 2 to 3 times before people ever receive a benefit from Social Security, so it's a little bit more difficult.
Okay, and yeah, so in summary, there is a claim process no matter how you get your coverage, and the ways to, at the beginning, just to acquire coverage is you can get it through your employer. Most employers have that. If you want to get supplemental coverage or you don't have it through your employer, you can purchase it on the private market. And you can also, in some situations, get protection from Social Security, which we'll talk about in a little bit. And we'll keep moving here. Okay, our next slide. Importance of income protection. I think we've done a good job of talking about this so far. And for the sake of time, I think we'll go right over to what to look for in a policy.
Yep. So definitions. So the definitions can vary. We have what we call own occupation, which is specifically what you're doing. So if you're a lawyer, a doctor, we can specifically tailor our policy. So if you're not doing that specific occupation, you can get a claim on it. Then we have what we call modified own occupation, which says you're still not working in your occupation, but you're also not doing anything else. So if you're not doing anything else and you're not able to do anything else, you can still make a claim on that policy. And then kind of a weaker definition that we see is this, what we refer to as any OC, which is where the carrier will say, if you can't do any occupation, it's determined that you can't do any occupation, then you can have access to this policy. So there's different definitions of disability that we really have to look at. Income, for the most part, the general rule of thumb is 60% of your income. Now, don't think just because you have that group policy at work that you're going to get 60%. What a lot of people don't realize is those policies that are taken out by your employer that are giving you a benefit, those benefits are taxable. So whereas an individual policy is non-taxable, these group policies tend to be taxable. So if you're paying tax on 60% of your income, you're really not receiving 60%. So that's when it makes sense to really kind of look and supplement with an individual policy to try to get you to that 60%. There's also caps on these policies. You might hear that there's a $5,000 cap or a $10,000 cap. So if you're a higher income earner, you're going to be reversed. You're going to have reverse discrimination there, and you're not going to be getting that same 60%. Reputation. Now, fortunately for the individual disability carriers out there, I'd say they're all very financially strong carriers. But that is important, and depending on how much coverage you have with a carrier, we're going to want to make sure that it's with a really highly rated carrier. And then we get into the skills, and where the skills more make sense are with those interesting occupations, and the easiest ones to kind of understand are doctors and lawyers. And the reason I bring those up is there are certain doctors that are very specialized, some that are working with their hands, like a surgeon or a dentist that's working with their hands. We want to make sure we have the proper specialty own occupation definition coverage in there. And then the last is really those high income earners. So those income earners making more than $500,000, you can't just buy disability insurance from 3 or 4 different carriers to help make up that gap. The traditional marketplace, you're probably going to cap out at $45,000 of monthly benefit. And for those high income earners, we have to go to the high limit marketplace. And that's when we're getting into like the Lloyd's of London situations to cover those high income earners.
Okay. So, and then speaking of this, you were just talking about your company policy. A lot of people will say, you know what, I'm just covered with what I have through work. And people, we also hear, you know what, if I'm not covered through work, I'm going to be covered by workers' comp, or Social Security will cover me from a disability perspective. Would you mind speaking to that, Brad?
Yeah. So workers' comp, what you have to understand is that's for on-the-job type of claims. The majority of claims that we see, again, heart attack, stroke, cancer diagnoses, those aren't going to be workers' comp. So it's really kind of out of the picture. In Social Security disability, we kind of talked about it a little bit earlier. It's very difficult to make a claim on. Very few people end up receiving Social Security disability. And it also has limits to it. So, I mean, at the high end, you might get $2,500 a month from Social Security disability. And in this day and age, $2,500 a month isn't probably going to cover much of your lifestyle.
Yep.
So I think that's it for that one.
Okay. So for the sake of time, we're gonna skip over executive disability coverage. And then we've talked a little bit about reviewing your coverage. Do you have any last words?
Yeah, I would say, yeah, when it comes to disability insurance, life insurance is a little bit easier. There's very small amounts that you can get for life insurance coverage through your employer. But I think what's more critical is for those people that have disability insurance through work, and getting to understand it. I think very few financial professionals really go in deep to figure out what those benefits are that you have through your employer. And that's one of the things that I've worked on with Andrew, is just doing those benefit reviews. Let us take a look at what you have through the employer so you understand what you're getting, and you can make the decision to whether you should supplement that coverage or not.
Yeah, just to echo that, yeah. So you want to just make sure you're taking a look at exactly what you have. Perhaps supplemental insurance or other insurance doesn't make sense for your plan, but just figuring out exactly what you have so that you can make the best decision for yourself and your family. And that goes for disability, that goes for life insurance. You hear a lot of times people say, I have AD&D, accident, death, and dismemberment insurance, just understanding what that is. So we're here to support you in all of that. If you want to reach out to us, please feel free to do so. Thank you all for joining our presentation today. I hope you found it informative and made you a little less scared of this topic. And if you have any questions, again, don't hesitate to reach out. Have a great day. Have a nice Halloween, and we will see you in November for our next webinar.
Thank you again, Andrew, for having me here today.
Yeah, thanks for coming, Brad. Really appreciate it. Bye, everyone.